Measuring and managing customer profitability. The only value a company will ever create for its shareholders and owners is the value that comes from its customers. Companies that want to be competitive must focus on the customer and on how they can be retained and made more profitable. However, not all customers are created equal. Some people are surprised to learn that some customers are less profitable than others. Part of this stems from how a company measures profitability. Traditional reporting does not contain enough detail to show the customer-related expenses. Low-maintenance good customers are ones that place no-fuss orders, make no returns, and require no extra services, and therefore have low customer-related expenses. In contrast, high-maintenance bad customers want specialized goods or services, constantly return items, and frequently contact the company's customer service line, which increases costs. With these thoughts in mind, there needs to be a way to measure the difference between the two. This leads to a pursuit of the truth about profits. One measure is to discover profitability levels. Knowing these levels can reveal answers to more pertinent questions relating to customers. To find these levels, a company needs to know specifically where profits come from, and to be fully aware of its expenses and cost structure. What method will allow the company to do this? Activity-based costing is the method that will economically and accurately trace expenses to products. It uses multiple stages or levels to separate and follow costs into the final cost objects. This allows more precise reporting because it recognizes the relationship between cause and effect. It can even follow indirect costs and turn them into direct costs, which used to be nearly impossible. The software that is used flows costs flexibly and proportionately, and eventually reassigns all resource expenses into the final costs of products, customers, or service. Using the cost assignment paths in the ABC model, resource expenses can be traced to each type of customer or even each specific customer. Through ABC's unique ability to trace expenses and consumption, it is able to detect unrealized profits. This profit cliff image is the cumulative buildup of each customer's profit. It reveals the company earns a substantial amount of profit from a minority of customers, roughly breaks even on some, and then loses profits on the remainder. Management usually believes that only a few customers are unprofitable, but ABC reveals that they have large profit makers and profit takers instead. However, customers can be worth more or less to a company at different times. This is referred to as the customer lifetime value. A customer that is not profitable now may become so in the future. Accountants can use CLV measurements from before and after marketing campaigns to see which customers can reach the highest profit increase from the campaign, enabling marketing to use resources more effectively. In addition to identifying customers with the highest return on investment, another benefit of having this kind of information is using it to move customers from a lower level of profitability to a higher level. The different activity cost drivers create profit margin layers that makes it possible to have a valid profit and loss statement for each customer and groups of customers. This allows management to look closely at them to see what is affecting the profitability and find a way to improve the return on customer. The two major layers of profit margin for a company's P&L are the product mix margin and the cost to serve margin. Figure 5 shows groups of customers at varying levels of profitability. A larger circle indicates higher revenue, but as you can see, by looking at the largest circle in the lower left corner, highest sales volume does not always yield the highest profits, since the circle is still almost entirely on the unprofitable side of the grid. The goal is to generate more profit from customers everywhere on the grid, pushing them toward the upper left corner. So now that the company has all this profit information, what should it do with it? It should use the information to increase profitability. Following are a few options to accomplish this. Lower each customer's cost to serve, reduce services that customers do not value very much, raise prices, taking the market into consideration, improve business processes with higher productivity, and upsell and cross-sell toward richer, higher margin products. In conclusion, there is so much more to the information that is available to accountants. The ABC method is a way for CFOs or accountants to use that information and expand their roles beyond their current duties by using it to support sales and marketing. Sales and marketing can then target the more profitable customers to retain, grow, and win back, and also require new, relatively more profitable and valuable ones. Thank you.